TELUS is the second largest telecommunications company in Canada. This is the calendar year dividend payments of TELUS from 2007 until 2020 and the first half of 2021. As you can see here, this record has been predominantly good and they have been increasing their dividend payments to their shareholders year over year. Right now, they are sitting at $1.18 a share, and that is an increase of 5.2% from 2019. If we are to base our decision on whether or not TELUS is a good investment only on the dividend payouts, we can certainly make that conclusion that TELUS is indeed a good one. But we have to look further and deeper into this company and truly identify if the earnings per share and the free cash flow together with the operations and revenue of this company do warrant the increase on the dividend payments of this company. One interesting statistics that I wanted to show you is that the payout ratio of TELUS sits at 130.8%, and that means that they will pay 30.8% higher than the earnings per share of the company. This therefore means that the earnings do not cover 100% of the payout ratio. If you see here, the dividend coverage ratio is only sitting at 76.4%. Now, if you have been watching any of my videos in the past, you will notice that the payout ratio is always one of the filters that I talk about. This is mainly because the payout ratio is important when it comes to long-term dividend investing. And long-term profitability can only be achieved if the company is earning cash and keeps sufficient amount of that cash internally in order to grow the company, and then the rest can be paid to its shareholders. If the company is not able to cover the dividend payouts to its shareholders, then the question arises, how does the company pay the dividends? And this could only be achieved through two ways. Predominantly, this could be through debt or liabilities, taking on debt. And the second one could be that the company is issuing more and more stocks in the stock market, thereby diluting every single share of the company, and therefore the value of the stock will drop. But let us not jump into any conclusion without seeing the financials of the company first. We are now at macrotrends.net looking at the current assets versus current liabilities of the company from 2005 until June ended 2021. The current assets are the assets of the company that it can quickly sell in order to cover or pay for the current liabilities of the company. The current liabilities are the debt of the company that it would need to pay in the next 1 year. Now, at the bottom here, what you will find is the current ratio. What we want to see here in the current ratio is at the very least 1.5 ratio. 1.5 then means that the company has got $1.50 worth of assets that it can cover for a $1 worth of liability. And here, looking from 2005, this was actually the first time in the last 15-20 years that the company was able to record such number. It's 1.4, meaning the company has got $1.40 worth of assets to cover $1 worth of liability, and this only happened in 2015 again at 0.99. That's not even one ratio. And in June 30th, 2021, they are sitting at 0.94, wherein the total liabilities is 5.31 billion and the assets is sitting at 4.97 billion. Therefore, they have got so much more liabilities that they could cover by the assets. Now, you may ask, why is current ratio important? And it is certainly important because this number tells us the liquidity of the company, the company's ability to pay its debt in the next 12 months with its asset without taking on further more debt. We are now looking at the income statement of TELUS. So here we see the revenue, which is the top line, and this is the net income, which is the bottom line. So this statement ranges from 2010 until 2020, and I would say that this is a good outlook for the timeline of this company. And here at the bottom, you will see the basic earnings per share of the company, which we will get into deeper later on. I have actually input this information on an Excel sheet for a clearer understanding on these figures. Here, from 2010 until 2020, the revenue of the company and the increase of the company's revenue had been on average at 2.97%. And here on this column, you will find the net income of the company, net income versus the revenue in percentage, and the net income growth. So here, the net income of the company company versus the revenue on average here is at 10.98%, meaning this figure, the actual net income of the company or the bottom line of the company, is about 10 to 11% of the company's revenue. In the industry of telecommunications, the average net income or profit margin is sitting at 17%. So here it is sitting at 10.98%. We can therefore make an assumption that this is below average. In this column, you will find the net income growth in percentage of TELUS. So how it goes is that in 2011, the company grew its net income by 22% as compared to 2011. They grew this furthermore in 2012 as compared to 2011, and so on and so forth. In short, in the last 10 years, the company grew its net income at a rate of 2% in the last 10 years. What's interesting though is that if you will find here in 2013, the company actually did not grow its net income but rather depleted it. They recorded multiple years where they had depletion on their net income. And this is the same in 2015, the same in 2016, and the last one that they had a recorded depletion on their net income is in 2020 at minus 32%. Minus 32% is not a joke. This, at least to my books, is a lot bigger than the increase on the what they had on their revenues here. So the question now is, if the company's revenue only increased at 2.97% in the last decade and the net income only increased at 2% in the last decade, how come the company was able to increase its dividend at 8.7% in the last decade? And this is a question that I wanted to find out for myself. Really, to me, as I read the financials of this company, here it seems that one of the major factors that they lean on is issuing of common stocks and further getting into debt. This is the annual report of TELUS in the year ended 2020. Here on page 47 of the annual report, equity offering, it says that on February 26, 2020, we issued 57.5 million common shares at the price of $26 a share for a gross total proceeds of $1.5 billion. $1.5 billion. Mamma mia! The proceeds of the offering were used for general corporate purposes, including funding, opportunities, and capital expenditures, and reduction of indebtedness. Now, if we go back, the 1.5 billion, mama, is equivalent to the net income of the company already. As a matter of fact, 1.5 is much higher than the net income of the company in 2020. 1.5 billion is almost 10% of the company's revenue in 2020. And if you put more notice here, the company had to have this money for general purposes, to fund growth opportunities, and to pay debt. So the company needed to have more shares to be issued in order for it to be able to pay its debt. And this in itself is not a pretty sight. Another factor that we have to look for is the free cash flow. According to Investopedia, free cash flow represents the cash available for the company to repay creditors or pay dividends and interest to investors. In short, this is the available cash that the company can employ to further pay creditors or dividends and other things or liabilities that the company needs to pay. And therefore, this is important for us to look for. This is now the free cash flow per share of TELUS from 2010, which is 0.0771 until 2020. I want you to see here the history of the free cash flow per share of this company. You will find in 2011, the company recorded negative free cash flow, and this is the same in 2013, 2014, 2015, as well as in 2016. And as a matter of fact, they also recorded negative free cash flow in 2019. I have input these details on an Excel sheet here. As we mentioned a while ago, the free cash flow is the amount of money available to the company to pay debts, to increase operation, to employ in order to improve the business in totality. And here in this sheet here, you will find two 2010 until 2020, the company's free cash flow had been recorded on multiple years on negative territory, such as in 2011, 2013, 14, 15, 16, and then 2019. But what is questionable really is that even so that the free cash flow per share were recorded on negative territories, the dividends per share of the company were increasing. As a matter of fact, in 2011, they increased the dividend per share as compared to 2010, and then they increased it again in 2013, increased it in 2014, 2015, 2016, and again they increased it in 2019. Really, this becomes very questionable because if the company does not have enough free cash flow per share, where does the company take its payments on dividend payouts? And the answer lies here on the equity offering of the company, wherein the company issues even more shares in the stock market for sale, thereby diluting every single stock ever bought by any investor. And this, ladies and gentlemen, is not necessarily the kind of investment that we want. We want long-term profitability, and if our money or our shares is diluted every single year, we have to look somewhere else. This certainly, with all the figures that we have seen, with all the earnings per share and the free cash flow per share, the revenue and the net income, I would say, to me personally, I would not invest on TELUS. Actually, I am not invested on TELUS, and do not base your decisions on dividend investment through the dividend yield and the dividend payouts alone. You have to look deeper and further into the finances of each and every single company that you would want to buy. Thank you very much indeed for watching this video. I hope that you gained value in this video and in my channel as a whole. If you did gain value in this video, please like, share, and subscribe. And I hope to see you certainly on my next video. Thank you very much.